This program is brought to you by the National Association of Insurance and Financial Advisors, promoting political advocacy, education, and the ethical conduct of its members nationwide.
Welcome to NAIFA's Programs in a Box. Today we're going to talk about the fully insured defined benefit pension plan. Probably a concept a lot of you haven't heard of or may not be familiar with, but I think you'll find it very helpful to your practice. This is really about maximizing tax deductions for your clients with guaranteed retirement income. It'll be presented by myself, Max Coulliette, and Nick Paleveda. So we'll kind of hit the disclosures just so you're aware that each individual situation is different, but we are here to help, and NAIFA isn't responsible and seek legal counsel and all those wonderful things that this says. But let me tell you a little bit about myself, just in way of introduction. I'm Max Coulliette. You'll see that I have some alphabet soup behind my name. I've been in the business 31 years. I started out in the business to become a financial planner. I've worked in the Seattle, Washington market. I've been in a home office of an insurance company for a few years. I've been a general agent. I've done a lot of these things, done a lot of qualified plans. Probably between Nick and I think we figured out we've done over 450 fully insured defined benefit plans. So we have some experience in the area we're going to talk to you about, and I've also done the CHFC CLU and some of those studies, and I'm currently pursuing one more that's specifically focused on qualified plans. Because as you'll see, as Nick introduces himself, he's the master of everything with all the designations he has. But I'm going to let Nick introduce himself.
Oh, hello. My name's Nick Paleveda. I'm a tax attorney. I actually received my master's in business administration from the University of South Florida in Tampa, where it's nice and warm. My law degree at the University of Miami, because it was too cold in Tampa, so I went south to Miami. And then my master's in law in the area of taxation from the University of Denver. So I've been to quite a few schools, practiced before the U.S. Tax Court, the U.S. Supreme Court, and right now I'm an adjunct professor at the Wealth Management program. Actually, it's the Master's in Trust and Wealth Management program at Campbell University in North Carolina. And I've been the lead faculty member for Northeastern University's graduate tax program in the area of retirement plans. So today what we're going to look at is one of our most favorite topic, which is fully insured defined benefit plan. So Max is going to take over, and I'm going to join you later on this meeting.
Well, what we're going to get into is that topic of fully insured defined benefit plans. And now, so you understand, first of all, not everyone qualifies for a fully insured defined benefit pension plans. However, hopefully today we're going to show you how they fit a lot of your clients out there. And in today's marketplace, I don't know if you've had clients where a few years ago their 401k became a 201k, or they feel whipsawed by the market, and they're looking for more guarantees. In fact, I forget which industry magazine I was reading. It may have been the association's publication, but it talked about how clients are looking for guarantees. I just read that on the plane. And fully insured defined benefit plans offer those types of guarantees. So, in introduction to this, it's one of the fastest growing business areas, and probably will be till at least 2020. Why? There's all us baby boom generation folks. I know I'm one. I'm in the middle of that pack. And to a degree, we're kind of like the pig the python swallowed. And as we've been moving through the python of time, we've been popping ribs and changing things. Well, one of the things we're changing is we've got to save more for retirement. So that's a big field. In fact, there's a 27% growth predicted in employment compared with a 10% average in the job sector, specifically relating to qualified plans. And also, remember, there's really no problem when you look at retirement plans feeling like you're undereducated in this field. because frankly, most CFPs, or CPAs rather, haven't had as many courses as a CFP on retirement plans. In fact, unless they've gone to a master's in tax program, they probably haven't had any on defined benefit plans. And if they've gone to a master's in tax program, because I have one advisor I work with, and she has a master's in tax, and she had one course for one semester on retirement plans. So there's not a lot. The MBA schools don't teach it. The medical schools don't teach it. They're just not exposed to these things. And so what do? Left to our own devices, we go to what the media tells us to do, which is the 401k, profit sharing plans. The insurance industry, though, has really been the leader with the defined benefit plan industry. Back in 1921 is when it really began, with Metropolitan Life Insurance Company introducing one of the first retirement annuities. And that was used in a fully insured defined benefit plan. Now, I get advisors as I talk about this that are constantly saying, well, Max, how can I ever become qualified to do these plans? I don't know about the products. Well, yes, you do. My question is simple. Have you ever sold a fixed annuity? Okay, you now have one half of the plan taken care of. Have you ever sold a whole life contract? You now have the other half of the plan taken care of. Now, not all fixed annuities and not all whole life contracts fit in a fully insured defined benefit plan, but most do. And they just have to be issued unisex, and there are some specific requirements. But those contracts build up guaranteed values, which in a fully insured defined benefit plan is what it's all about. It's about guarantees. Because does the stock market have guarantees? Or even the bond market, does it have guarantees? You know, we're in a low interest rate environment, and if interest rates go up, bond values will go down. So we're all talking about guarantees. So what we're going to have here is an introduction to qualified plans and what they're all about, because that's really important for you to understand as you talk to business owners. Because you've got with qualified plans defined contribution plans, which are the traditional plans we all hear about. You know, I came in the business in the early 80s, and 401k plans came about. And that's the hot thing, and a lot of businesses moved to the 401k plan. And that placed a lot more responsibility on the employee versus the employer. Well, defined benefit plans, which were the most popular plan prior to that, started to shrink. But what we're seeing today is a growth in defined benefit plans. And why? Because the business owners are needing them. And we're going to have some case studies in a few minutes to demonstrate what we're talking about here. Now, why do business owners need qualified retirement plans? I have focused in the business market most of my career. And I have found there's one major myth that all business owners buy into. And that myth is, my business is my retirement. Is that really true, though? You know, I have a business owner lately that I've been working with. He had created a buy-sell. An employee was going to buy the business. The employee had gone out and solicited loans and all these neat things, okay, to buy this business. They had had the documents drawn up. Everything was done. One Friday morning, the employer came in and said, hey, I'm sorry to tell you this, Dave, but I got a job offer I just couldn't turn down in Texas. I'm not going to buy the business. All of a sudden, all his retirement plans went where? Out the window. His wife, as we call it in Scouts, is not a happy camper. So, what do? We need to have other things for that business owner to depend on, because what's the one constant in life? It's change, isn't it? That's the constant. And in today's society, that change is happening faster and faster. Now, why else should they have it? To maximize tax benefits. Because a business owner, if I'm a business owner and I put money into a 401k versus a defined benefit plan, I'm going to pay more taxes than a defined benefit plan. I'm going to let Nick get into that a little more. But that's a big issue, because how many of your business owner clients want to pay more taxes? Do lots of them want to? I don't meet them. So if you've got clients that want to pay more taxes, you're unusual, because that's not the norm. Also, they need to solve for liquidity concerns that occur at retirement or death. Because just like this business owner I just gave you the example of, he had all kinds of plans for the next year. All his plans went out the window because his business is not liquid. he's got to start all over. He says, I may have to own this for another 4 or 5 years because I've now got to find a new buyer. They've got to learn this business, all of those things. Another big issue is sheltering assets from legal liability and creditors. Our poster child for that is O.J. Simpson. He has millions and millions of dollars in judgments against him, yet he still collects his NFL pension with no hits. Why? Because it is a pension asset. It protects them against liability from creditors. We had a doctor client up in the Seattle area, got into a lawsuit, one in Montana. The biggest shelter they have is their pension plan. Plus, it's for avoiding taxes on excess earnings. Just had a business owner a few months ago that one of the main motivating factors for him to do this kind of a plan was our corporation is sitting on a lot of excess earnings. We don't want to pay the taxes. What's a strategy? And we had sat down with a CPA, had given the strategy using a fully insured defined benefit plan, and the CPA said, I like it. We presented it to the business owner. The next question the CPA asked is, Max, I've got 2 or 3 clients that this may work for. How do I get more information on this, and how do we get proposals to them? So once they understand it and see the advantages that are available for that business owner, even their other advisors, their tax advisors, are going to be interested in this. Now, another one to really consider is your retirement properly funded? Okay, that's another question for your business owner. But ultimately, you, as their advisor, their insurance agent, need to know the fundamentals. And that's where I'm going to now turn some time over to Nick and let him delve into those fundamentals so that you can get a better feel for what this is all about.
Well, welcome to my portion of the presentation, which will deal with qualified retirement plans. And of course, my favorite topic is fully insured defined benefit plans. And as Max described, anybody who has an insurance license and, of course, an appointment with a proper carrier should really look at this as a very valuable tool that you should have in your tool chest when you're meeting with a client. Because this is a way where when you sell a whole life policy and sell an annuity and you combine them inside a trust, you can make it tax deductible for your client. I can tell you your clients can be very happy because they're able to receive a tax deduction for the purchase of insurance and annuity contracts within the plan. So what are these qualified retirement plans? Well, a qualified retirement plan provides retirement benefits. In other words, the biggest benefit they get out of this is that when they go to retire at age 65, 62, or we even did a case where a client was age 75, he funded for 5 years and retired at age 80. A lot of people say, well, I didn't know you could set up a retirement plan at age 75. Yes, the rules say you can do it for 5 years and get deductions for 5 years in accumulations. So the biggest benefit is you're setting up assets that are growing for retirement inside your annuity and your whole life contract. It also provides a certain amount of disability benefits. Wait, I didn't say any disability benefits. If you look at the annuity and the insurance whole life converted to a lifetime income, and this is on all policies that take place, that actually provides disability benefits inside the plan. It is not a true disability policy, so I never tell clients drop your disability policy. But if you did become disabled while you're in a fully insured plan, you'll be able to receive disability benefits. Death benefits. What are death benefits there for? If you die, you're the breadwinner. What happens to the surviving spouse? What happens to the children? What happens to everybody? Well, your income stops. In a fully insured plan that has death benefits in there, you buy enough death benefits to replace the income, otherwise known as a qualified pre-retirement survivor annuity. That's what they say in actual geek speak. So that this way, if you have $1 million death benefit, you'll be able to give your client about a $60,000 a year lifetime income. People don't realize how huge your death benefits have to be to replace the income, but think about it in our low interest rate environment today. And I told clients years ago when I met them and they came in with $1 million. And I said, well, how are you doing income-wise? Oh, I make $100,000 a year. Well, how do you do it? Well, I have my $1 million in a CD, and the CDs pay 10%. I'm making $100,000 a year. I guess life is pretty good for you, right? Today, I have that same client come in. I said, what do you have for your retirement? I got $1 million a year. I said, what do you have your money in? I have it in CDs. What are you making? Well, about 1%. I make $10,000 a year. I'm in poverty. Now, think about it. The same millionaire today is in poverty because of a low interest rate environment where 20 years ago, they were making 10% and they were living like kings. So you have to think about this. With a low interest rate environment, you need a larger lump sum amount to provide for that income. So they need larger death benefits. The General Accounting Office says you need about $3.4 million to replace a $210,000 lifetime income. Now, the other thing about retirement plans, you have to meet specific Internal Revenue Code requirements. This is where Max says you have to work with a good TPA, and I agree with him. In other words, if you're going to be in this area, you're going to be working as a team, not as a lone wolf. It doesn't matter how good you are. I know a lot of people say, well, I'm really good. I know how to do this insurance and annuity stuff. I'm a good salesman. We have to think about this as a team event. So if you're a quarterback like Andrew Luck, I'm really good. I don't need a team. And 11 people show up on the other side, and I'm going to go throw the football, but I have just me, you're in deep trouble. So when you're working in qualified plans, I can promise you, you're working with a lot of people. You're working as a team. You're working with the CPA, the enrolled actuary, and the tax attorney. And you get to qualify for tax-favored treatment. Now, this is a big push by Congress. They're saying we need to encourage people to save more for retirement. Now, how are we going to do that? Try to twist this person's arm, tell this person what to do? No, they're not going to do that because we know Americans, we're going to do what we're going to do no matter what. So what they did is they put into the Internal Revenue Code all the tax incentives for funding for your retirement, which is one we're speaking about is insurance contract plans. So the provisions are put in there and you have congressional policy in your favor to fund these plans for somebody's retirement. Now, when we say cannot discriminate, you cannot discriminate. There are what they call anti-discrimination rules. If you have highly compensated and non-highly compensated employees, you cannot discriminate with them. But do you have to contribute the same amount? No. If you have a person who's replacing a $200,000 income versus somebody replacing a $20,000 a year income, you have to fund a lot more in for the person who's replacing a $200,000 income. So even though you would think, oh, wait a minute, this person's getting $100,000 a year, this person I'm only putting $1,000 a year, you may still pass the non-discrimination rules under ERISA, which we'll talk about later. Okay, two main advantages for the employer's contribution, and the reason people do this is the taxable income is reduced by the amount contributed. In other words, you get a tax deduction for doing this. And I can tell you, all my clients were excited. They first got in. They love this because of the tax deduction. 2 or 3 years later, or 4 years later, they're looking at, wow, these accounts are growing pretty good. That's because they didn't pay taxes on it. And when can I retire? And if you have dentist clients, I can always tell you, they're saying, I want to retire tomorrow. Some dentists, they really don't like what they're doing. But if you think about it, every day I'm getting in somebody's mouth. Well, you do that for 10 years, you want to retire. Okay, so it's just the way it is. So they become good clients. They want these retirement plans. So the retirement savings can grow on a tax-deferred basis, which is the advantage of setting up these fully insured defined benefit plans. It's a tax-efficient retirement plan. Now, there's two types of qualified plans that we talk about. Number one is defined contribution. That's what everybody knows about. And it's the simplest. Well, I can put $18,000 into my 401k. They just announced those rules in 2015. $18,000 can go in. Everybody knows that. Then there's defined benefit, and they make the rules a little more complicated. The amount necessary to replace your income at age 65. Well, how much do I fund in? I don't know. In other words, everybody has to be calculated differently because everybody's age is different and salary is different. So how much do I have to put in now and put on an annual basis? By the time I'm age 65, my income will be replaced. That's called a defined benefit pension plan. So it's structured a little different, and some people just throw up their hands and they say, oh, it's actuarially calculated. So you basically calculate how much you can put in your defined benefit plan. Defined contribution plans have other rules. You can put up to 25% of compensation for tax-deductible contributions up to a maximum of $53,000. That's a defined contribution. So if somebody's making $100,000 a year, they can only put in $25,000. Now, in a defined benefit plan, it's different. It's the amount necessary to replace your income to a maximum of $210,000. So if a person's making $100,000 a year in a defined benefit plan, do you know they may be able to put in $100,000 a year, not $25,000. They don't have that limitation. So because their limitation is based on how much will they be able to take out when they go to retire. And to take out $210,000 a year, they need $3.4 million, at least according to the GAO. So you need to fund a lot of money. So when I see a doctor or a lawyer or a pharmacist come in, they say, well, I've saved for retirement. I said, really? How much do you make? Well, I make $200,000 a year. So you have $3.4 million in your retirement plan. Oh, no, I only have $1 million. Well, we already know $1 million's not enough. That's only worth $10,000 a year. You're in poverty. You need $3.4 million. And then they get on the stick and they start realizing they need to save more for retirement, which is the whole objective, is to encourage your clients to save more for retirement. Now, in a defined contribution plan, your retirement benefits receive basically their account balance at normal retirement age. Defined benefit plan, you place a contribution to give them a percentage of their salary. I can tell you also in practice, even though we fund for that benefit, over 95% will take the lump sum equivalent and roll it to their IRA. They won't take the lifetime income. You always fund for the lifetime income, but at the end of the day, we tell our clients, like we have one now, oh, you have $2.7 million in your annuities and your insurance contract. What do you want to do? Terminate and roll it all to an IRA. It's just, and again, it's their decision. They want to take the lump sum amount or lifetime income. Remember the 401k? $18,000, but it has a different rule, up to 100% of salary, as opposed to defined contributions, 25%. Now, if you think this is confusing, it is. As I tell people, ERISA is confusing and built to stay that way. So the thing is, you're wandering your way through these little rules that exist. But I can tell you, if you go to these presentations, like I've done, Max has done, and do these presentations, these rules will be the same over and over, and eventually go, okay, this is what it is. And the profit sharing plan is the lesser of $53,000 or 25% of salary. So these are all the what we call the basic rules and defined contribution plans and defined benefit plans. Here's how a defined contribution plan works. Age 25, you have 40 years to fund at $10,000 a year, you'll reach $400,000. But if you're age 55 and you started funding at $10,000 a year, you only have $100,000. So you don't have enough money in your plan. You started too late. And that's part of the reason the defined benefit rules were placed into the code, is they wanted to encourage the people in their 40s and their 50s to save more for retirement because they need to save more and they have a very short horizon. The pension benefits are, of course, set by a plan formula. In other words, you want to replace 100% of your salary, 50%, 75%. It's a formula that actually goes into your legal document. The annual contribution, the most you can replace, is the amount that will give you a $210,000 lifetime income. And there are limits on each participant's annual contribution, but there's no limit on the annual contribution. So what does that mean? Well, there's no limit and no dollar limit as to how much you need to fund in, but there's a benefit limit for like $210,000. That's the rule in 2015. That's the maximum benefit you can receive. So let's take a look at a defined benefit plan. You have somebody who's age 25, and they're going to contribute $25,000 a year. By the time they're age 65, they'll have $1 million. You have a person age 55, they need to contribute $100,000 a year, and by the time they're age 65, they will have $1 million. So oddly enough, if you put $100,000 in for employee A and $25,000 for employee B, given equal salaries, you've met the non-discrimination rules under ERISA. So you actually have what they call actuarially equivalent benefits, and that's what you look in defined benefit plan. Now, how does a fully insured defined benefit pension plan works? What happens is that the business makes tax-deductible contributions to the plan. The plan is actually a trust document. And I don't know if you've seen trust. If you've worked with living trust or you work with trust at all, it's like in pensions trust, they're usually about 100 pages. Okay, you take the pension trust, you go to the bank, you open up a bank account, it has its own tax ID number in the name of the trust. Next, the business owner takes the money from his corporation and puts the money into the trust. Once he does that, he can go to the Form 1120, line 17, if he's a C, or line 23 if he's an S, and deduct it. Because now the money's in the pension trust. From there, these funds are written to the insurance company for the annuities and life insurance contracts. They're actually going to be owned by the trust, which the person who's the owner is usually a beneficiary of the trust, and so are all the other plan participants. So this will provide them the benefits, and they have to fund it every year until they retire or they terminate the plan. Once they terminate the plan, then they can distribute the benefits or roll them into the IRAs. So what type of plan funding in a fully insured plan? And this is the beauty if you're in the insurance business and it's not a security. Okay, one thing about fully insured plans, you can't have securities in there. So if you're into mutual funds and stocks, you're in the wrong space. The only type of instrument allowed is a fixed annuity or a whole life contract, or both, basically. Basically, in most of the plans, you'll have both. You'll have annuities, and you could have fixed annuities only. We call them annuity-only plans. And you could have a whole life contract, and that's it inside the plan. Now, why is it so restrictive? Because the government is looking for the guaranteed element of the whole life and the guaranteed element of the fixed annuity, and that there's no market risk. Because remember, these plans are going to guarantee the benefits at normal retirement age for the participant. So as I tell the producers and the financial advisors, go take a whole life contract illustration. Take it, look at the values at age 65 or 62. Have them start funding today. That lump sum amount that you have in your whole life contract plus an annuity contract, that's what we're going to use for their retirement benefit. But what happens if they die? The whole life contract has death benefits in it to replace that lump sum for the survivor. So it's a very important and very powerful product you want to have in your tool chest when you meet the right client who goes, I'm paying a lot in taxes, I own my own business, or I'm a professional. What can I do? My CPA doesn't tell me anything. Not unusual. They're filling out returns. My tax attorney is doing litigation. Nobody's helping me in this space, which is what I've seen after 14 years, because you're in the small pension market. Contributions less than $1 million a year. Okay? But at the same time, let's think about it. Our plans, they put in $300,000 to $400,000 a year into the plans. That's probably the average plan, with the average life being about $70,000 in life and $200,000 in annuities, which is around $270,000, let's say. Do you know most actuarial firms won't touch it? It's too small. Now let me ask you this as an advisor. If somebody comes to you, I'd like to buy a life policy, $70,000 a year going life and $200,000 annuity. Would you be interested in servicing that a little bit? Remember, the actuaries aren't. So they need somebody to help them out. And that's where you as a member of NAIFA can actually help your client establish that $270,000 going in, all deductible, giving them benefits, and then you have about a $70,000 life sale. And I'd say that's probably the average that I've seen over 14 years in doing 450 of these plans. So what's the end result? Large current tax deductions. Remember, driven by the Internal Revenue Code, because Congress can't force you to save for retirement, so they're going to say, we're just going to give you all the tax benefits. Guaranteed retirement benefits. I have a lot of clients call me every year. What is my retirement benefits going to be when I retire? And we have it all calculated. What do I have currently in my plan? Here's what you have. Currently in the plan, it's pretty interesting. The insurance producers all know, if I said, what's the cash value in the plan right now of the life contract? They'll give me a number. What's the surrender value of the annuity? They'll give me a number. In actuarial speak, they call it the accrued benefit. By the way, if you ever read the Internal Revenue Code, the definition of accrued benefit in a fully insured plan is the cash value of the insurance and the cash value of the annuities. So you already know what accrued benefit is. But isn't it more interesting to talk about accrued benefit? Say, we'll look at your accrued benefits. Okay, it's the same thing. Matter of fact, it's in the Internal Revenue Code. Accrued benefit is that. Okay, so what's the bottom line? For each dollar you contribute to the fully insured plan, the government will fund 30 to 60 cents of your retirement through available tax deductions. If you look at it from a rate of return aspect, it's tremendous. I mean, where are you going to go to get a 30 to 40% rate of return on your investment? Virtually guaranteed. Well, look at what you can save in taxes by setting up a qualified plan. I've run some analysis of you actually borrow the money from an outside source and you fund your retirement plan, you're actually better off. Certainly in the first several years, because if you look at it, you're borrowing the money at what today, 7-8%, and you're funding the plan. In some cases, you're getting a 30-40% deduction. So if you look at the trading on the equity, you're actually better off if you can do so to actually, in some cases, not all cases, borrow money and fund your pension plan. It's just the way it works. Traditional defined benefit plans versus fully insured. So we're talking about the fully insured plan. What about the traditional defined benefit plan? What's the difference? If you have stocks in your plan as opposed to guaranteed products, you're now in a traditional plan. And as Max described, what's the problem with the stock market? It always goes up, right? We earn 12% a year every year, right? In 2008, when I had close to 300 plans that year, the market crashed 37%. I'll never forget it. All these phone calls, what's happened to our money? And we did our analysis. You went up 3%. They were grateful they didn't crash because they were all in fully insured plans. It's not tied to the market. A traditional plan is, so you can lose, and then you can be forced to make early contributions or quarterly contributions. Your plan could be underfunded, subject to penalties, as opposed to fully funded in a fully insured plan. And you could have quarterly contribution deadlines as opposed to filing prior to filing your tax return. So there's a difference between the traditional and the fully insured defined benefit plans. Fully insured are just easier to work with, again, less than $1 million annual contributions. So what about life insurance inside a fully insured defined benefit plan? It can provide lifetime income to the surviving spouse or a lump sum deduction. The tax it can be fully tax deductible premiums. People say, what about the PS 58 costs? That you can take out, then the death benefit will go tax free. If you don't take the PS 58 cost out, it'll go as a lifetime income taxable to the surviving spouse. But the key thing about the insurance, it provides benefits against premature death. So if someone dies while they're a participant in the plan, to replace it, we have the death benefits inside the plan to do so. Now, I'll tell you one more secret after doing this for years. I mean, like decades, literally. The insurance products are better than they ever were in this respect. Years ago, and I'm not talking about so many years ago, we didn't have these accelerated benefit riders that are there. What does that mean? Years ago, we had these death benefits to replace lifetime income. Today, the death benefit actually, in most cases, will give you long-term care benefits. It'll give you chronic illness and terminal illness benefits. In other words, there are health benefits in your insurance contracts today, and they didn't even exist 3 to 5 years ago. So I will say out there in the space, there are plans all over the place, including ones we've did, that probably should have their insurance upgraded to have these accelerated benefit riders placed in. But I find very few people even talking about the accelerated benefit riders that should be placed into all the pension plans. Right now, I can tell you a lot of our plans, they have not been upgraded yet, and people should seriously look at upgrading their insurance and add in on these features, these accelerated benefit riders. Life insurance and fully insured defined benefit plan, there's no reduction in the retirement benefit. It'll stay the same. Lower net cost since you're basically buying insurance with tax deductible dollars. You can increase the contribution and maximize the tax deduction. This is a very interesting phenomenon. If we run a traditional defined benefit plan, we can put in X dollars. If we run a fully insured, you put X plus Y because you're allowed to fund in more for the death benefits, and it doesn't count against your funding limits. So you can actually fund more in a fully insured DB plan than you can into a traditional defined benefit plan if somebody wants to fund more into the plan. One of the key things provides a source of income for loved ones if someone dies. We had a client, one of our plans actually died a couple months ago. Now they have the death benefits in the plan to provide for their beneficiaries. The economic benefit cost is reported to the employee annually to preserve the income tax-free status of the death benefit, but I'm also telling you that's an option. If they don't want to, then the death benefit will come out, but it'll be taxable in the form of a lifetime income. Life insurance can be continued after retirement. When someone dies, one of the key features is they can buy the insurance policy out into an irrevocable insurance trust if they need it for estate planning purposes. What's the buyout? Well, that's interesting. According to the tax court, it's fair market value. You buy out at fair market value. And that was the case that came out of the tax court called Schwab versus Commissioner. So you want to look at that. If they want to buy out the policy to use the death benefits for their estate plan, they can do so. So life insurance in a fully insured defined benefit plan is cost effective for this reason. Let's take a look at the cost of a $10,000 premium using pre-tax dollars. Outside the retirement plan, because we had to pay taxes on it, it can be as high as $16,667. $10,000 premium, $6,000 in additional taxes. If we do a fully insured plan, it's at $10,000 or even better. Complicated area, one of these complicated areas, and you should work with a good TPA. So we're looking at some frequently asked questions. Here's the first one. Do I have to include everybody in the plan? This always comes up. I have 10 employees. Do I have to include them all? The answer is no. The rule is you need to include 40% of the eligible employees, which means I need to bring in 4, but I can exclude 6. I had one CPA, I was doing a presentation in Denver. I said, well, if you got, how many people do you have? I got 10 employees, 2 doctors, 2 spouses. How many do I have to bring in defined benefit? I said 4. The 2 doctors, 2 spouses. They go in a profit sharing or 401k. He goes, well, how long has that rule been around? Let's see, that's 401A26. It's been around since 1974. I mean, this is an old rule that you do not need to bring everybody in the plan. We have one plan right now. We have 50, and they have over 120 because the rule is really minimum of 2, maximum 50, 40%. Remember, the rules are always confusing, but that's what the rule is. And so they're well over 100 employees, and we have 50 in the defined benefit plan. Will my contribution remain constant? The answer is no. Now, if you read the code, it says specifically you have to have level annual contributions to normal retirement age. But if you read the regulation, interest rates, credits, dividends are used to reduce the contribution, so your contribution would actually go down. There's another adjustment called a salary adjustment that may take place if you use a career average salary in the plan, lowering the contribution or increasing the contribution. So it will not remain constant. Okay? Even though it provides for level, the regs say you reduce it as you have experience that exceeds the minimal contract guarantee. So who can benefit for fully insured defined benefit retirement plans? Primary people, medical practitioners, veterinarians, pharmacists, the professional groups. Next are what we've seen as niche businesses that are making a lot of money that want to shelter their money for retirement. And then, of course, there's a certain play right now in the business transition market, which we're not going to discuss because it's beyond this scope. It's called the Thousand Oaks transaction. We're going to have to talk about that at a later presentation, but it's used in business transitions as well. Eligibility, you may exclude part-time employees. If your employees are not working 1,000 hours, you don't need to bring them in. Less than 21, you don't need to bring them in. They haven't been there for a year. You don't need to bring them in. So not all employees. We had one data sheet, had all these employees. I think I had about 100 of them. 10 were eligible. They didn't meet all those requirements. Or you can exclude 60% just right off the bat from the numbers. And once you get those 10 eligible, I can exclude 60%, so I only had to bring in 4. So you really have to know eligibility. One of our enrolled actuaries said you should spend 2 weeks on eligibility, but I know in practice, nobody's going to spend 2 weeks on eligibility. Maybe your TPA would. Vesting, now the employees come in and you're in the plan. Do they get the funds? Well, they have to stay with you for 6 years. Now in Silicon Valley and the engineers that we work with, they like the 6-year graded vesting. Even presidents of trust companies and banks I've worked with, the company likes the 6-year vesting because then they know that employee's going to stay for at least 6 years. Now, the vested employees cannot lose benefits even if they leave before retiring, but you do have to stay for at least 6 years to be fully vested. The following year's contribution, what we went over before, is reduced by interest and dividends in excess of the guaranteed rates of your insurance policy. So here's what a fully insured plan looks like. It starts off year 1 and then starts going down. Traditional defined benefit plans, contributions go up, then it goes down, then it goes up, then it goes down. Very much more difficult to manage. I tell people if you're even going to do a small traditional plan, you budget $5,000 to $15,000 a year for that. In a fully insured, you may budget $1,500 to $2,500 because it's easier to manage. You're running a PC as opposed to a mainframe. So it really depends on what the client wants. So who can benefit from a fully insured defined benefit plan? Based on income, high income taxpayers pay more taxes. They like the defined benefit plan. Age, as you get older, closer to retirement, they like the defined benefit plan because they can fund more in. And when the numbers of years to retirement shrink, then they want the defined benefit plan. So who can benefit from a fully insured defined benefit plan? We've worked with clients from 35 up, but I actually have some people in the movie industry, they call it the industry in Southern California, they're in their late 20s that have set this up. But most of them are usually 35 and 45, 55, and they're within 10 to 20 years of retirement, although we've had clients as old as age 75 who've set this up. They have few non-owner employees. If they have a lot of employees, it can be difficult because to meet the non-discrimination rules in ERISA, you have to provide some benefits for all those employees. and desire to contribute as much as possible to their retirement on a tax-advantaged basis, and they want conservative investments as opposed to speculative ones, because when you're working with guaranteed insurance and annuity contracts, we're working with guaranteed, conservative value investments as opposed to ones that you may do well, but you may lose everything. The plan you have to establish in writing, which is due before the end of the fiscal or calendar year. So if you want to plan for this year, you have to do it by December 31st. Can you do it on December 31st? The answer is yes, but please don't. We had 6 people or 8 people this year contact us on December 31st to set up the plan, and you can do it and it'll be good for the entire year. And then funding, you have until you file your tax return, including extensions to fund it. And then every year you have to do what they call Form 5500. So what about a fully insured plan? They're ideal for select businesses. Not everybody fits these, but for select businesses it can work, providing larger tax deductions for them, cost-effective death benefit if needed. And when I say if needed, if you run into the client, well, I'm single, I have no kids, I have no spouse, I hate everybody, that's probably not a good person to have a death benefit for, okay? So you want to make sure that the person is suitable for the death benefits, and then you put the death benefit in the plan. So with that, we're going to take a look at the case studies and bring back up Max, and we're going to take a look at some case studies and plans we've done and plans that you can do for your clients to help them out going forward.
All right, let's talk about this whole topic Nick started on with supercharging the retirement. But to really do that, let's look at some case studies, because that will help you better understand who this really qualifies for, because it really makes a difference talking to the right people about these plans. First of all, let's take a look at John, who owns a company. He has a solo 401k he's been contributing to. He's been contributing $18,000 a year plus $6,000 as his catch-up because he's over 50, or $24,000. So why should he set up a pension plan? Well, first of all, John's 401k contribution is subject to taxes, Social Security and Medicare taxes. Since he's the owner, he pays those taxes, which in this particular case would be about $36,000 and change. And that's before he makes the contribution to the 401k. Now, how many of your clients would like a load on a 401k contribution of $24,000 of $3,600? They would think that's exorbitant, but that's in essence what they paid in this kind of a case. So what happens? John switches to a pension plan. What does that do for him? First of all, we wipe out the bill on the taxes. We're not going to pay the $3,672 in taxes. So over the next 15 years, he will have saved an extra $55,000 in change by using a fully insured pension plan. That's the beauty of this. We've taken a very simple case, and we can do those small solo 412E3 or fully insured defined benefit plans, make it very effective for the client, very effective for you as the insurance advisor, because believe me, you'll make more in those cases. But we've really benefited the client because we've saved on the taxes. And that will apply in a lot of cases. So that's one case study that's a very simple, very typical plan I think every advisor runs into on a regular basis. Let's look at the next one. Dr. John, he's been contributing $53,000 a year into his profit sharing plan. Dr. John would like to contribute $100,000 a year, but his CPA says it's the most he can do. Okay, so what does Dr. John do? Well, if we set up a 412E3, he may be able to contribute $100,000 a year into a fully insured pension plan. The contribution is based on age and salary, so the actuarial calculations would allow us to do this. The plan assets are held with a major insurance company. And again, that has to be a domestic insurance company. We can't play any games. It has to have a guaranteed interest rate, and it needs to be no less than 1% or their declared rate, whichever is greater by the insurance company. Typically, we're averaging around 2 to 3% in today's low interest rate environment. And the declared rate has ranged really as high as up to 7%, but typically 3 to 7. And he'll be able to keep his 401k if he wants to. Now, the question sometimes comes up is, well, how does Dr. John afford to contribute $100,000? How many of you have business owners that take a salary out, but they also have K1 income? coming out of that business. So they're taking a salary of, say, $100,000 a year, but they've got K1s, which are another $200,000 or $300,000 or more perhaps a year coming out. In essence, what we're doing in this type of a case is we're reducing the K1 income. We're not reducing the salary that he needs for lifestyle in that scenario. We're simply taking the K1 incomes that would be taxable and eliminating them, taking them off the tax rolls. So it creates a win-win. In this case, we're able to put more money away for the doctor as well. Now, here's number 3. Dave has a successful company, his wife and 3 employees. Okay? Dave wants to set up a plan. Wow, he's got 3 employees. What do? He sets up a plan and contributes $100,000 a year, but he's concerned about including employees. Do employers have that concern? Absolutely. Why? Because one of their biggest worries is, how much does it cost me to do these things because I've got all these employees out there, and what do they always hear? You've got to include the employees, which is absolutely right. But now, if they do this plan, he doesn't necessarily have to. So what we're doing here is Dave and his spouse participate in the defined benefit plan. We meet the participation requirements by using he and his wife. The other employees don't have to participate in the defined benefit plan because they're included in the profit sharing plan with a voluntary 401k. So what we've done in this case, in this particular example, was we made a contribution, sort of a safe harbor contribution as we call it, of 7.5% to be contributed by the employer to the employee's profit sharing plans. By doing this, again, in this scenario, we're usually contributing over 90% of the contribution into the plan for the benefit of Dave and his wife, which is what most people are looking for, is that kind of contribution. And then combining it with a 401k and profit sharing plan. Now, the 401k is typically set up as voluntary, but it allows Dave to contribute more money to that if he wants. And that is his go to Vegas money, as I call it, because now he can take risk on that. Why can he do that? Because if he has a defined benefit plan where everything's guaranteed, he just got a permission slip. Remember those when you were in school, you had to get the permission slip to go down the hall or whatever? He has a permission slip to take that 401k and be significantly more aggressive. I'll tell you a quick funny story. Had an advisor from a large investment firm in my office, and he was questioning me on this concept of a permission slip. So we had the whole discussion, and I drew the circle up there, and I said, here's your client's pool of assets. He says he's a moderate, investor. How much of this pool of 100% is going towards bonds and money markets and fixed accounts? And he says, it's, about 30, 35%. So I said, okay, 30, 35%. That's his DB plan. That's the fully insured defined benefit plan because it's all guaranteed. What that means is as we look at this thing on a more holistic approach, this allows him to close that gap on the 401k and be more aggressive. And that's what this kind of a plan allows. Now, here's case study number 4. Barbara's a farmer. Okay, Barbara can save about $50,000 a year, but is concerned with the safety of the investment and the fees. What can she do? Because that's usually the big concern. Because what do people hear about with defined benefit plans? Well, that's going to cost you $3,000 or $4,000 or $5,000 a year. In a fully insured plan, it's a lot less costly. Why? Number 1, PBGC. We don't have the same premiums of $500, $600, $800 per participant. Number 2, they don't require as much administration because we don't have to have the enrolled actuary testing. In fact, we just have a case that Nick and I are working on where the client wants to use, stocks, bonds, and mutual funds. Well, it costs more because there's more actuarial time involved in doing that. So, what do? Barbara sets up a fully insured plan. The assets are held by a major insurance company. They're backed by also the state insurance guarantee funds. Okay? And you have to, of course, check those limits by each state because they'll vary. But look at that. That's something else to talk about when someone wants the absolute guarantees. Barbara generally will receive a tax credit because she's never had a qualified plan of $500 a year for 3 years. And that offsets the cost of administration and could reduce the cost of the plan. And as a single employer, she now has a defined benefit plan, but as a single employer with one participant, she files a Form 5500EZ. Again, less administration in this kind of a case, therefore lower cost to do this kind of a defined benefit plan versus traditional. So, what are some pictures of what this might look like? Here's another one. Don has a company with 50 employees. Don is older and more highly compensated. The company has a profit sharing plan. They're putting in 8% contribution. That can he benefit from a pension plan? Well, I'll give you an example. We do a lot of these plans on medical practices. I am amazed at how many medical clinics have a profit-sharing 401k, and the total contribution from the employer is about 8%. There are a lot of those out there. In those plans, they don't have to change anything. So, generally, yes, using a floor offset arrangement, the employees need no more or very little contribution, additional contribution, as they've already exceeded what's called the gateway of 7.5% of pay. So John may be able to contribute $200,000 a year to the plan with little or no employee cost. And now you just have to consult a TPA to do the math, because you have to have an enrolled actuary do the math. But you've now accomplished something, because they didn't change what they already had. That still existed. They simply added the defined benefit plan and allowing, in this case, Donald to put away $200,000 a year versus what he might be able to at 8% of compensation into a 401k and profit sharing plan. So again, we've created a win-win here. Now, something else so you kind of understand when we're doing these is that when we're doing this, it also creates a win for the advisor, and I'll talk about that here in a minute too. Here's case study number 6. This is a medical practice. This is very, very typical. In this case study, you have Dr. Smith, age 50, Dr. Jones, age 55. Names, of course, were changed to protect the guilty, but here we go. You have the employees, and you can see their ages there. So what do we do with this plan? We do this. We're calling it Smith Medical Custom Carve-Out Plan. And what we've done here, as you'll see here, we've taken the 401k contributions, the profit-sharing contributions, we've split it up, and the defined benefit contributions. So by doing that, we've increased the benefit for, you'll see Dr. Smith is getting $152,000. Now, why did we do that in this case? Dr. Smith had said to Dr. Jones, you know, I'm older than you. I'd like to get the heck out of Dodge and figure out how to retire quicker. What this has allowed is Dr. Jones put a lot less into the plan, allowing Dr. Smith to have more going into the plan, therefore allowing him to accumulate enough assets so he's comfortable with retiring and getting out of the practice sooner. So this can actually be used as well in business succession planning, and was. You go back in the 60s and the 50s, this was a common tool used by law firms and CPA firms and other organizations to move the senior partners out of the practice. So here we go. There's a case study that demonstrates that. Now, some other things, you've got to understand, for the business or professional who'd like to maximize tax deductions and guarantee retirement, the fully insured defined benefit plan may be the answer. So, again, for the professional or business owner who wants to maximize taxes or tax deductions, this fully insured defined benefit plan can be the answer, because it can help them. And you provide a service for them. You have the opportunity to create more income and revenue for yourself and your practice. So you've got a win-win in this scenario. So if you have questions, because there are a lot of things you have to deal with here, get hold of Nick or myself, and we can help you with that. Now, also to help you with that, welcome back, Nick. Now's the time to talk about your book, because it'll help these advisors get answers to all these questions about fully insured plans.
Well, thank you, Max. The book area I've been working on for about 5 years now, designing a lot of different books, and some that can be used for you. If you go to Amazon.com, you'll find this one. It's called Fully Insured Defined Benefit Plans, and it's thin, so you can actually spend a couple hours reading it and then get the basics and refer to it There's not much written on fully insured defined benefit plans. A tax-efficient retirement plan, which Max described because of the Social Security and Medicare taxes. The fact is, you put money in this plan, you don't pay the Social Security and Medicare tax. You take money, put it in your 401k, you're going to pay that extra 15.3%. So it's a very valuable tool to have in your tool chest if you want to go on along the lines to get into fully insured defined benefit plans and become a retirement planning expert. Realize there aren't too many people in this market space. 4,000 enrolled actuaries, 15,000 people total, managing nearly 20 trillion in assets. So a lot of opportunity if you want to get involved in fully insured plans. For those who are really geeky and want to learn more, I have the handbook of retirement plan. Now this is a little thicker, and I can guarantee you this is what we use at the graduate tax program at Northeastern University. It will take you a while to wade through this, but this goes through all the different types of plans, including fully insured defined benefit plans. I'm doing this year a 2-volume set because the government just put out more new rules in this area, and they continue to put out new rules. We're here to help you learn more about this area to the extent you want to learn more about this area. We're going to help you learn more about this area because this area is a vastly underserved area, a vastly underserved space. People that want to put 50,000 to $1 million away. Because, and Max and I know that if somebody says, hey, I want to put away 400,000 a year, we have a hard time. Actuarial firms won't even talk to them. It's too small. I want to put away 300,000, not interested. I had one group, I said, I've got 30 doctors, too small. We're looking for at least 1,000 employees. So this is a very underserved group. If you decide you want to become an expert, learn the area, and you're halfway there if you know about insurance annuity contracts, certainly it's a great space and great opportunity for the people out there, and we're here to help.
And you could really help those business owners because they're looking for a way to contribute more. There's a lot of us baby boomers out there, and retirements are underfunded. And that business may not be the right place to have all their retirement assets. So thanks for listening today. Hopefully this has been helpful to you, and have a great day.
Thank you for participating in this program. For more information regarding products, programs, services, and other NAIFA member benefits, visit www.naifa.org.